So I have taken the extract of that question information in a sheet, in a working sheet to do that. So here you can see here, do you remember there is an equation called, there is an equation for finding out the profit. Yeah, this is the equation saying profit is equal to closing equity minus opening equity minus additional capital plus drawings, right? So you can identify your profits or losses using this equation, right? You might have studied this equation in your first unit, so that it will be easier for us to continue with that. So if you have any questions, you can comment it, so I will reply for that. So closing equity, how can you find out the closing equity? They are telling you to find out the profit for the year ended 31st March as per the question 2024. You have to find the profit for this. So 31st March 2024, 31st March 2024, these are the closing dates. So this is the opening date, year opening. Year starts on 1st April 2023 and the year ends on 31st March 2024. So these two are closing. So now how do you find the closing equity of this? So you have to get, you know that to find out the closing equity, so we have an equation called net assets. And net assets is the equity, that is total assets minus total liabilities. Or else you can use another equation for this, that is you know that asset is equal to equity plus liabilities. So you just make the equity as the subject, then it will be assets less liabilities. So both are same, right? So in this part, what we are going to do, we just substitute the assets. So closing time, so let's take the closing, because we are going to find out the closing ones. Okay, closing equity. So you have to take the data of the closing time, right? That is total asset at the 31st March 2024 is 4.8 million minus liabilities are 750,000. So there you get your equity as 4,050,000. 4,050,000. Right, 4,050,000. So your closing equity would be 4,050,000. Minus opening equity. What is the opening equity? So equity can be said in other words capital. So there is only one figure for the opening, that is this one, that is 2 million. So you have used this figure, this figure, this figure for your calculation. So minus Additional capital. So additional capital is 800,000. This one. So minus 800,000 plus drawings are 400,000 plus drawings 400,000. So your answer will be 1,650,000. So answer number 1. So let's go to question, that is answer number 1, 1.65 million, right? So answer number 1. Question number 1.5. The prime entry book which is used to record by a seller for return of the good sold on credit. What would be the answer? It's very easy. That is a prime entry book which is used to record by a seller. Seller is recording for the return of goods sold on credit. So he sold goods on credit. Now those goods have been returned, right? So how do you record those return? Return outwards? No. Return outwards day book. That means this book is used when you as a seller, when you are returning to your supplier the goods that you bought. So basically seller returns the goods to the supplier. So that is when he is doing that kind of return, you have to use returns outwards day book. Return inwards day book. So that means that is the return book or the returns that received from the customers to the seller. So that is inwards, coming from outside to inside. So outside will be your customers and the return is coming, the goods are coming to the seller inside. So the seller will record these returns that are sold on credit in the returns inwards day book. Purchase day book is the book that is recording all the purchases. Sales day book is the sales, right? So that is not related to any return. So returns inwards mean the returns coming from your customers to the sellers, and return outwards mean that is the return that is going from the seller to the supplier, right? So answer will be number 2. 1.6. Sam Traders purchased a motor vehicle for 4 million rupees on 1st April 2022. The policy of the business is to provide depreciation on the diminishing, that is called reducing balance method, at the rate of 20% per annum. The carrying value or the net book value of the motor vehicle as at 31st March 2024 was how much? Let's do this in our separate whiteboard. So this is the question that I have transferred to the whiteboard. Let us do this question. So Sam Traders purchased. So he purchased the motor vehicle for 4 million rupees on 1st April 2022. So it's a reducing balance method, and 20% per annum is the depreciation rate, and the carrying value they are asking on 31st March 2024. So basically, if you draw a timeline here, 1st April 2022, he is buying it for 4 million. Then from here to here he is going to use it until 31st March 2023. That is mean for 1 year he is going to use. So for the 1 year there will be, after 1 year there will be a carrying value. Then after that, the next year, the second year would be 31st March 2024. So this is year 2. So here they are asking what is the carrying value for year 2. To calculate this is very simple. Just take the cost, which is 4 million, and depreciation for year 1 would be 4 million into 20%, which will be 800,000. You minus it, then you will get 3.2 million. This is the carrying value. Carrying value, let's say this is carrying value 1 and this is carrying value 2 for the second year, so this is carrying value 1. After 1 year, the carrying value would be 3.2 million. Thereafter, what's happening is you have to calculate. So carrying value is 3.2 million. From that, you have to calculate again the depreciation for the year 2, which is 3.2 million into 20%, which will be 640,000. You minus that, then you will get the carrying value 2 for the second year, which is 2,560,000. Right? So this is the answer. Answer will be number 3. Okay? Right. If you have any questions, any doubts, you can comment it. Right? So I will explain it, or I will do another video for your questions. So let's move on to the other question. Question 1.7. Kusal started a furniture business, a sole proprietorship business, introducing a motor vehicle worth 2,500,000 in cash. Select from the following the correct impact to the accounting equation from this transaction. So basically, if you look at this question, so introducing a motor vehicle and cash, so which means he is introducing a capital, right? So he is introducing a capital. So the motor vehicle is a non-current asset, or we can call it under one name, assets. So since they are talking about accounting equation is assets is equal to equity or capital plus liabilities. So when he is introducing a motor vehicle worth 2 million, the asset will go up, right? The asset will go up by 2 million. Plus, when he is introducing cash 500,000, again cash is a current asset but coming under the common name as asset in the accounting equation. So again the asset is going to go up by 500,000. So both are assets which is going to go up by 2.5 million. 2 million plus 500,000, 2.5 million. So asset will go up by 2.5 million. So if you look at the answer number 1 plus mean increasing by 2.5 million. Answer number 2, assets increasing by 500,000, which is wrong. Answer number 3, increasing by 2.5 million is correct. Answer number 4, 2.5 million increase is correct. Okay, so now 2 is eliminated. 1, 3 and 4 out of 3. Now we should know that these are not a liability. So in the answer number 3 and 4, liability is also in the other side of the equation after the equal sign. Liabilities are also increasing by 2.5 million in the third answer. So this is not a loan. He didn't take a loan or something like that. He didn't buy on a credit. He has given in cash. He has introduced directly a cash, and he has directly introduced a motor vehicle. So there is nothing to think about liability here. Nothing he bought on credit, right? Nothing is credit. So Answer number 3 is wrong. So basically this is a capital introduction. So answer number 4 also wrong. It's a capital introduction. So the answer will be number 1, which is 2.5 million assets will increase by, and capital will increase by 2.5 million. So this will be the answer, because he is introducing 2.5 million worth assets.